Thank you. Anyone? Bueller? Anyone? At least my sisters are going to laugh at me. It's and the other thing that's so funny is it's appropriate that it's the 40th high school reunion for my class, 74, because no one's sitting in the front. Well, you guys, but Stephanie, I expect it from you. But everybody's sort of in the back. I'm promising to only take 20 minutes because TED Talks take 20 minutes, and since I'll never be asked to do one, this is about as close as I'm going to get. So instead of 2 hours, which I've been known to do, yeah, okay, fine. Wonderful to see 40th reunion classmates. Dear Brighton friends, my last year I spent a lot of time in Brighton. My dear Renda from piano. All the LGBT classmates that are making up a good percentage of the room. My teachers, John Strazabasco, Sherry Holzer, Gil Petrie. Did anybody else come in? I can't believe you're here. I honestly can't believe you're here. Dear friends, to mention anyone else would be to leave out others. But Bruce, John, everybody, even my brother-in-law came. That's. I think maybe Barbara probably dragged you, you know. So, yeah, right. All right, enough of that. So, I thought that after John and I really move around a lot. How can I, Penny? Is it all right if I just? Yeah. Yeah, I don't believe in staying in the same place. So after John and I were asked to go out to Google in Silicon Valley and speak, I thought, all right, that's the high point. That's basically everything's downhill from here. But this clearly is a higher point. To be with a friendly crowd, whom I don't know. You gave me a look like, what, friendly crowd? It's a real pleasure. And I'll spend the next 20 minutes talking about what a pleasure it is. And then you can read the book. No. Remember book reports? And if you want to know what happened, you can read the book. Right? No, I won't do that. This book is 2 books. It's for accounting nerds, people who love numbers, people like Bruce. Bruce's son. Where is the son, Bruce?
Running.
Uh-huh. Fine. He'll go far. Bad pun. Yeah, people who deal with numbers, people who enjoy financial statements, who know about business, and that's not too many of us. Now, the other part of the book is stories. Well, how do you find the stories? There's stories about, come on in, the weather's fine, there's seats right up in front. Oh, okay, that scared him off. Woody, I mean, like, you know, come on, you know. Woody is managing the reunion for the other high school and was gracious enough to come. And has been running reunions for, I don't know, 30 years, Woody?
Easily.
All right, very good.
He embarrassed me to come up with this.
All right, well, you know. So what we've got here is we've got how to dig into the numbers so that a stock doesn't blow a hole in your portfolio. And as my good friend Jimmy Dutcher said, you know, I'd like to have a portfolio. That sounds like a good thing. How do I get a portfolio? Well, you own stocks, whether you know it or not. If you have a state pension, for example, like teachers, a lot of this audience are teachers, we're in education, the pension fund's invested in stocks. If you own mutual funds, you own stocks. Now, you don't have to necessarily, no one here is probably going to be analyzing their own stocks the way I do. I do it for a living, right? There are only certain people that are so geeky. But it's kind of like when you get a second opinion on surgery you're going to have, let's say. You don't just take the first doctor's opinion. You go to a second one because she, being a she, will give you a better idea. But you need to know enough about money to know what people are doing with it, who manage it for you, or know enough when you get statements what's going on. It's not simply a matter of, do I have more money this month than I had last month, which is it's too short a period, right? So what John and I tried to do was to basically write one book that would be for professionals, in the sort of find all the errors, find the problems, all the legal stuff that management can do in the financial statements, perfectly legal, and then one day they can't keep the numbers up anymore and the stock crashes. And then the other book is for people who would like to know a little bit about what my controversial view of the money management world is and of stocks, and maybe take away something like that. So for example, I got pilloried online in one review for having actually been funny in the book. And I sort of thought, well, what, it's castor oil? Do they still have that anymore? Mary Poppins. So it's that John and I wrote something that we thought would be serious, but all, in terms of the numbers and backed up by data, but also interesting, we think, but then we would, are stories that talk about how to look at money and how to look at investing, even if you never buy a stock. Now, that guide will be on the table on your way out. That's the unofficial guide to what pages to read, okay? And 3 of the pages are find the bad puns, okay? It's all your fault. No. So let's look at a couple of things here. It's 1973. Wow. And I'm in front of a room and I'm telling you General Motors, Woolworths, and Eastman Kodak will all be bankrupt in 33 years. Seriously, you would have thought I was high, right? You would have thought I was completely nuts. These were the great stocks to own. General Motors, that dividend, you could own that all your life. And this is what happens to pretty much everything given a long enough period of time, except for a small group of stocks. We're sold by the financial industry that there's stuff you can just buy and hold forever, la-di-da-di-da-di-da-da-da, but it's not actually the case. Consider those companies, right? These were widows and orphans stocks. And no, I'm going to make a bad joke about Kodak. My dad worked for Kodak for 30 years, put me through college, and fortunately, he didn't live to see what has happened. But capitalism has losers. Capitalism just doesn't have winners. So you're in 1973 and you're looking at those 3 companies and you're thinking these are the greatest things and they're going to last forever. We don't have socialism. There are winners and losers, and it's this constant creative destruction where if you're making a lot of money, somebody will come after you and try to do the business better and take away market share. And this just happens over and over and over. So the companies we know that have survived are subject to survivorship bias, where we look at all the statistics and we don't see all the ones that are gone, right? We only see the ones that are, I see some knowing smiles about survivorship bias. So the Blackstone Group Blackstar Group did a study from 1983, 10 minutes, I'm going to go over. They, no, I mean, I said 20 minutes, but, and please, if you had enough, just go. Nobody, so, I mean, really, my sisters have known to do that for a long time. So, and friends. Now, where was I? Blackstar Funds, 1983 to 2007. They studied all the stocks that were in the Russell 3000. Okay, that's broader than the S&P. You know what the S&P 500 is? It's the 500 largest stocks in the country, right? Russell 3000 is the 3,000 largest. They make up 99% of all stocks traded on a daily basis. So it's the market, Russell 3000. So this firm did a study and they found that over 1983 to 2007, which is, carry the 24 years, that was for you, Straz, that 25% of the stocks were responsible for all the gains of the average. 75% of the stocks made no money. 39% of them were negative over the period, not just versus the average, negative. So when you own an average, 25% of the stocks are the ones that are going to do well. Why would you want to own the other 75%? Well, of course, I'll get to that. I have an answer. But this is capitalism, right? Everybody doesn't win. But we're sold by the financial industry this idea that, just buy this fund, just buy this guy, hold it, and meanwhile they take your fees. My friend, whose mother is 85 and has dementia, got control of her finances 2 years ago, started opening the statements, and you read this. You read this about happening to some, not to stereotype, but this is, widow in Florida, right? Because women live longer because they're stronger, right? So, and women end up with the money. The statistics show women end up with the money because we're weak and we go. So, remember I said I had sisters. I learned at a very young age. So, now of course I can't even remember where I was. Oh yeah, thanks. Right. So he comes to me because we're old friends and I manage money, and he says, well, I've been looking at these statements and I think he's churning her account. I said, well, what do you mean? Isn't he paid on a percentage of assets? 1%, 1.2%, and so his incentive is to make you more money so that he earns more on a percentage basis, right? Doing good so far? And this guy, for an 85-year-old woman with dementia, is buying and selling stocks all year long, never holding anything for more than a year because he's paid by commissions. So he's churning the account. I've never seen this. I've only read about this. So I hope you're all watching your parents' accounts and so on, because people do still get paid by commissions in some places. So we have to be alert. I'm not quite sure where that came from. I guess it was just, you need to know enough to watch the people who are managing your money, right? The kindly broker. This was a guy who was friends with the family for 30 years. If your money manager is buying mutual funds for you, even if they're index funds, that person is collecting a fee on top of a fee, right? Because the mutual funds charge fees, and you can buy mutual funds yourself. I mean, you don't need anyone to do that for you. All right. Let's talk a little bit about memory. The way that I think about stocks is the whole world that we live in today is a conspiracy to keep us from maintaining a thought for more than 30 seconds, right? Pretty much. We're on duty 24/7. We're expected to be, what? You didn't answer my text? Excuse me? And I feel quite guilty about that. And doing the reunion, it's like, what? You haven't replied on Facebook yet? I didn't even really do it until the reunion. Now I'm afraid it's crack. But if that's still around. Memory. Memory is what we need. And few of us, in this group, no offense, but we've all lived through actually a couple crashes. We lived through 2000, 2002, 2008, 2009. But the problem with people is that we think wherever we are in this world where we can't sustain a thought will always continue the way it is. Recency bias. And just as we had survivorship bias, we think that whatever is recent will continue. For example, what has the stock market done since March 2009? Just go up. Well, so people are starting to buy, like in 1999 and so on, all these crazy stocks with no profits. This time it's social media, right? Trying to think, of course, what's the craziest? Well, and then you have Netflix, which is selling for $100 per dollar of earnings. You buy these stocks today, and you will never see, on a portfolio basis, gains from them. I guarantee you that. Some will win, some will lose. But when you're paying these kind of multiples, well, why do we do this over and over again? Why do we buy high and sell low over and over and over again? Well, I'm glad people do it because it allows some of the rest of us who are value investors, when the bust comes, to buy cheaply. But it is a consistent thing, and it's a lack of memory, because we think that where we are will always persist. Now, you're a widow. Now, we're in 1973, and that was fun. What about 1929? What if we went back that far? All right, you're a widow. You're rats. I used to know the age. Nobody give this away. You have a 7-year-old daughter. No, that's not true either. You have a 19, 16 plus 13. You have a 13-year-old daughter, Your husband died 6 years ago of pneumonia. Shush. Of pneumonia. And you were left with the drugstore, 43rd Street in Manhattan. What kind of investments do you own with what you got from your husband and so on? Do you own stocks back then? What do you own?
Oil.
And you own their bonds. You own the bonds of those companies. Very few people are owning stocks. Operators are, because it's perfectly legal to manipulate stock prices until 33 and 34. That's something people don't realize. But if you're in 1929 and this is you're a widow and you've gotten a little nervous, maybe you have an ounce of sense, and you write to your broker, but you actually don't write, you cable, because it's fashionable, right? You live up, way up actually, 143rd Street and St. Nicholas Avenue or something like that. And you cable down to your broker, 6 Wall Street, and you write, the broker writes back. You write, what should I do? What should I do? I don't imagine she spoke that way. The broker writes back, Dear Mrs. X, July 25th, 1929. July. Okay. Howie's nodding. I know what happens. Another good friend in the audience. Answering your question, whether to sell. It would be well to wait for a break in the market if one comes. But I must confess, I cannot see where a general break is coming from. Well, I just told you Netflix, $100 for $1 of earnings. RCA, which was the tech stock of its day, more than that. I cannot see where a general break is coming from and believe the stock market should not be considered as a whole. And that investing in stocks day to day is a matter of selection of companies and not a study of market conditions. I agree with him 100%. But he was wrong. Sincerely yours, check it out, Ralph Waldo Earl. Yeah, his parents thought he'd be a philosopher. He was right about the fact that you can't predict where the market was going, but it just shows that over and over and over people do crazy things and they have no memories. Now, it's 1929. What could he have remembered? Well, if he's 30, 40, doesn't remember anything. When was the panic, the last panic and almost crash before 1929? Anybody know?
1907.
Excellent. And in 1907, the Hank Paulson was J.P. Morgan, because the Secretary of the Treasury didn't have the power at that time. And J.P. Morgan locked all the big bank heads, just like Paulson did when he went to New York, into the Morgan Library, and they were locked in from the outside. And he said, until we fix the banking system and save the country from disaster, nobody's getting out. In 1907, what did they remember? All right, so 1929, maybe they remembered 1907. 22 years before. Most of us don't remember investing-wise. Maybe we start in our 30s and 40s. If you were in 1907, what did you remember?
1870s?
1870s, 80s, and even into the 90s. The greatest deflationary depression this country has ever known, and everybody only thinks of the Great Depression. You had people living in tents, raising animals, at campfires in mid-Manhattan from the East River to the Hudson, right? Nobody knows this. It's the Great Depression. If we know anything, we know it's the Great Depression. Do kids today know the Great Depression? Well, kids today, right? So, it's all about memory. Maybe we remember 2008 and 9. Maybe we remember 2000, 2002. Do we remember 1973, 74? Most people don't. Earnings were going up. Companies were doing well. The market crashed 50%. Before that, we had 20 golden years after World War II. We need to remember always that there is never average. And that's why we wrote the book. We look on the dark side. We look, how much can I lose, not how much can I make? Because we know from the study of history, as Warren Buffett tells us, what we learn from history is that we never learn from history. But what else do we have? We can't just live entirely in the moment. Though, as a very wise person said to me once, Live in the present in all ways except financially, because time is on your side. If you do compound interest, which Einstein called the greatest miracle. With time in relationships wounds all heals, but it heals all wounds in financial matters. Over time, pretty much you can survive anything. But who has 20 years? Who has the time for every 20-year blow-up, explosion, depression? So, all right, people by 1907 have forgotten the 1880s. People by 29 have forgotten 1907. Then it's a very long time, a really long time. And it's the late 1960s. We're having another period that's just crazy. 73, 74 happens. If you're investing and you're 40 years old in 73, 74, what are you going to remember? You're not going to remember 29. You know, if you were really late, if your parents were really old, like I was, and my parents were really old and I was really late, though today, having a child at 40 is nothing, you would hear about the Depression and you would still buy internet stocks in the late 90s. You have to experience it yourself. So, I've told you a bunch of stories. I've told you that history is really important for us to understand in terms of investing and why. Well, we know the bell curve is crap, right? I wish I had a chalkboard. Where's a chalkboard when you need one? The bell curve, right? We're all taught, if you're in the middle, that's great, that's average. You don't have to worry too much about the outlier events. Well, the problem is most people invest as if they will only have the good outlier events, right? Bell curve, let's call this the good side. Bell curve, let's call this the bad side. The bad side is the market drops 74% and you lose your job, and you have to sell at a low. This is 1931, 1930, 1932, right? So the bell curve is all fun if you're in the middle, and if you're up here with all the big winners. But I've already told you how unlikely it is that you'll pick the winners, right? If 25% of the stocks from 1983 to 2007 are responsible for all the gains, what, you're going to pick those? Good luck. Over on this side you have wipeout. Now we all think that we had one bad week in 2008. October, the first week in October, the world was coming to an end. S&P 500 today is back up where it was. Wow, time to buy crazy stocks again. Of course, I'm scared to death, but I'm not scared because I'm taking precautions. No, I won't say that. Okay, so so great, Tom. History. That's all wonderful. So I'm concerned that things can go bad at any time. That's great. I'll read the stories in your book. That's all fine. All right, let's go have a drink. Well, what if you could only own the best of those Russell 3000 stocks, for example? In this book, we identify all sorts of areas where management can manipulate earnings. And eventually, they can't manipulate them anymore. The stock misses Wall Street estimates or something, and it tanks, and you wake up and you wonder, oh my gosh, what happened to this stock, right? Well, we have a bunch of indicators related to financial statement analysis, and I wish I could claim any originality in this, but it's all my co-author, who's younger and smarter, but at least I'm better looking. It's the S&P 500 without the F stocks. So we take all the stocks, rank them by quality, all the items in the book, drop the bottom 100, the ones that score F, and then weight them D, C, B, and A. Obviously the A's get the highest grades. And what was it in law school? Howie, the A's are on law review and the C's make money? I think that was it, that people who get C's go make money. There are a bunch of us lawyers and ex-lawyers in the room, Al and some others. So I'm not suggesting that this is how you invest. What I'm suggesting is it's a way to think about the stock market that most people in this room probably are and should be index investors, probably buy stock market indexes and put some money in over time and grow it, which is perfectly fine. What we thought, or John thought, I can bask in his reflected glory, is what if we can knock out the lowest ones lowest quality, and just be left with the highest quality. And that's FLAG, F-L-A-G is the ticker, hence red flags. And that's really our contribution to investing, as small as it may be. But we know that at any time, the mud can hit the fan. We've had a market going straight up for 5 years. Trees don't grow to the sky. We will have major corrections. Long term is fine, provided you keep investing regularly. But let's say you're somebody who got laid off from Hewlett-Packard, like my friend Scott Marks had an event for me in San Diego, and one of the people said, you know, a lot of us got laid off from Hewlett-Packard and we got a bunch of money. And you're, 62. If you put it all in the market at that point, you're market timing without knowing it. You're saying, well, this is some time where I can put all my money in, and I don't really care where the stock market is today. So you lose all the benefits of regular investing, right? Okay, so if most people are going to buy indexes, this is one solution that might be that you can own, perhaps. And then you can enjoy the stories in here. Now let's finish the story. So you already figured out by now that the little girl whose mother owned bonds was my mother and my sister's mother, hence brother and sister. And that the broker made the advice and my grandmother took the advice, and as we all heard the rest of our lives, things were not so good after that. The worst thing happened is they had to move to Rochester. Remember, this is a New York City girl, right? Oh, and depend on the kindness of relatives. My mother, at one point, my grandmother ran a hotel in Avon, and my mother took the milk run, the milk train or milk something truck into Rochester and studied at Rochester Business Institute to be a secretary, where she, because the money had been lost in the stock market crash, that was going to send her to Vassar, #1 in her class, at private school, the whole 9 yards. So this was a bit of a shock. As many women from that era know, was unusual for women to go to college anyway, and this was, a very bright, very talented person, and she just saw everything sort of blow up. Meanwhile, my father, his father was kept on at Morse Lumber Company. He had a job. If you had a job in the Depression, you were fine, but you had to have a job. They met, worked for Kodak for 30 years, had 4 great children, had their problems and their issues, but got me started in investing, and I think my father would probably think that unleashed a monster. And that was where we end up. So I hope that made some sense. Here's the deal. If you get a name tag to take over to the Cheesecake Factory, I will put a little flag on it, and they will take that flag off and give you a free drink. So the only catch is you have to take a name tag and write your name on it so that I don't have to remember, actually I have remembered everybody here so far, but that your classmates and friends can remember you as well. So regardless of what you do, get a name tag and a flag, and I may draft someone to stand by the door with those. Thank you, and then we'll have questions.